Good morning. It's good to be with you. Diane Slater called me at about 7:30 in my room this morning and said, "Are you here?" And I said, "Well, I'm not in the tropics this year." So I have been known to end up in the wrong place a couple of times. Only once, and it happened to be for you folks. So anyway, but it's good to be with you. It's kind of like old home week, having been on faculty here and living in this area for several years back in the late 1980s. It's good, always good to come back to Columbia. The little boy that was born over at the medical center is getting married this fall, so that tells me how old I'm getting. Let's talk about what's going on in the pork and hog markets with the outlook here. First, the legal stuff. Kerns and Associates is an introducing broker for FC Stone, and so we have to show you this legal stuff right here. And I'm sure you're about done reading that already. What it says is, if you actually trade and lose money on anything I say today, it's your own damn fault. So, all right. Key factors this year from February as we stand right now. First, world and U.S. economies. The world looks good at the present time. There's recovery in most places. We've even got plus numbers on the European Union for 2019, according to the International Monetary Fund. But there's some trouble on the horizon for the U.S. This thing has been good for a long, long time, and we'll talk about some specifics here of some indicators that are telling us that we may start seeing this run of growth and this run of increased GDP come to an end here in the foreseeable future. Meat and pork demand, we'll talk a bit about that on key factors. We've had a bit of a tough year on demand, on domestic demand. Not a disaster by any stretch of the imagination, and in fact, the November real per capita expenditures for pork were kind of back to where they were a year ago. So that's progress. But still, again, it's one of those things it's softened a bit from where we were a couple of years ago. We need to keep an eye on that. Exports and trade, of course, have been kind of the thing that's dominated all of our talk this last year and will continue to do so until we get some resolution to these. But they're awfully important. We'll talk about those. And African swine fever, of course, is kind of the topic du jour of any discussion in the pork industry right now. That might be pretty good, and it might be pretty bad. I've never seen in my professional career a situation where we had as much risk on both ends of the market situation as we have right now. Normally we're facing risk on one end or the other. This time it's big time risk on both ends, and we'll talk about how that might play out. Great 18 crops. They've got a little smaller according to USDA last week, but still they were very large. We have very good situations on domestic supplies, international supplies. The soybeans are great. Corn a little tighter. That's giving us some cost of productions that are favorable for the pork industry. And in fact, they might be the reason we kind of keep our head above water this year and next as we go through this. But we'll discuss those. Packing capacity and packer margins, of course, a big deal. We're going to have a new plant start slaughtering hogs on March 4th. That can have some impact on what's going on in the packing side. And of course, we'll talk about hog numbers and prices. On the macro side, conditions can remain positive. The world economic growth, according to the International Monetary Fund, forecast 3.7% this year. That's a big number. That's an awfully robust number. A little over 1% in the developing countries, about 4% in the developing, 1% in the developed economies, about 4% plus in the developing economies. That number has 6.3% in it for China. We say, gee, that's really great. Well, that's not so great when you're accustomed to growing by 10% per year. Their economy is certainly slowing down, but still worldwide, we're in pretty good shape on economic growth. Equity markets, we certainly have had another round of volatility, but we've gotten a nice bounce in the last 3 or 4 weeks. We haven't made up the ground that was lost by the technical correction, which it was large enough to be considered a correction there in November and December. But still, the equity markets have come back. Now, I think in light of what we're going to talk about in the U.S. economy, we could probably see some softening of that. But we had a long bull market here that has been very beneficial for anybody who's got money in a 401k or those kinds of things. The wealth effect has been positive for the U.S. economy over the last decade. Q3 real GDP growth was 3% right on the nose, which is what the president wants. And by God, the president's going to get what he wants. You got 3% growth in the third quarter. We think that that's probably going to slacken a bit as we go into late 2019. But this economy right now is officially, and I'll talk more about this in a minute, kind of in a boom phase. I mean, and what happens right after the boom phase? Yes, we see a peak and we start seeing some difficulty. So, we have growth, and then we have what's called the boom phase, which goes right in front normally of a cyclical peak. Real personal disposable income has moved back to growth again, and not just growth. 2.1% year to date in 2018, and we're still working with 2018 numbers because of the shutdown. But still, that's robust growth for this measure. This is real. Real means deflated. Personal disposable income means after taxes per person. And that thing usually grows 1% is a good number, 1.5% is a good number, 2% is a really good number. And so this is one of the reasons we've seen the economy kind of getting a little hotter, and people have a little more money to spend, and that's a positive going forward. The unemployment rate has bumped back up to 4% from 3.7%, but who's quibbling over 0.3%? We're still at full employment in the United States. A few years ago, when then IBP opened their plant at Logansport, Indiana, they opened a plant at the time when the Indiana state unemployment rate was 3%. And I was talking to Gary Mahan about that and said, Gary, how's it going? And he said, well, it's going okay, but I can tell you there's a reason that last 3% don't have jobs. Okay, so this is a challenging environment from an employment standpoint, no question. And I think it's going to be a challenge for the foreseeable future here, at least until we get some slack in this economy, or we get some holes in the new fence with Mexico. 2008, I have a feeling that a few of those might develop over time. So 2018 inflation rate, 1.9%. That's down from 2.1% the last couple of years. Now, this number was 2.5% at the end of October. Right? A 2.5% number and a 1.9% number are really, you say, well, gee, that's not that different. It's really different in the eyes of the Federal Reserve, okay? Because a number 2% or greater is a red flag to the Fed. Anything under 2% they can live with. And so we've had significant slacking of the consumer price index in the last couple of months. It is all driven by energy. What has gasoline prices done since November? Okay, all of the decline in the CPI over the last 2 months has been because of energy prices. Now, is that good? Well, yeah, it's good. But the point to remember is that 1.9, if you take out energy, and lots of times we look at core inflation, which takes out what? Food and energy, it's still well over 2%. So what does that mean about the Federal Reserve? Well, the Federal Reserve has been hiking interest rates pretty regularly. They had said they would probably hike them 2 more times during 2019. I think that it's still likely that they will do that. There was some talk by Chairman Powell about a month ago. Says, well, we're not real sure we have to do that. Maybe we don't have to hike them 2 times this coming year. But if core inflation is still over 2%, I think it's very likely we'll see 2 more rate increases by the Fed. And they're not going to let inflation get out of hand. It's a good sign that we pull back to 1.9, but when it's all based on energy costs that cause that decline, I don't think we can bank on them changing that much. Whoops, wrong button. Okay, this recovery is old. Here you can see through January we're at 115 months. The longest recovery on record was March 91 through March 2001 at 120 months. I would say it's quite likely that we're going to break that record before this recovery turns south. I think we're going to extend well into this year on the growth of the economy, and so that's a positive thing coming forward. Now, these are a little busy, but this is an important thing to show you. Dr. Bob Dealey runs an outfit called No Spin Forecast in Chicago, and Bob has forgotten more about macroeconomics than I ever know. But he has developed a model over the years called the Enhanced Aggregate Spread, which is over here on this left. And it works off of differentials between the unemployment rate and the consumer product index, and a differential between interest rates, short-term and long-term. And he puts those together just in a basis point spread. And when that thing goes below 200 from the top, it normally predicts a recession somewhere 9 to 18 months out in the future. And it has predicted every recession since 1900 with that kind of accuracy. It dropped below that 200 measure back in April of last year. So the 9-month projection would put us back out here into 2019. When we went below the 200 mark, it said 9 months from now we start recession-eligible months, which that was started in January of 2019. But notice, in most cases, it takes anywhere from the 9 to 18 months before the National Bureau of Economic Research declares that we're actually in a recession. Bob would say that's because they don't do any predicting. They do postmortems on the economy in order to do that. But you can see what has happened the last couple of times. The components of that are the enhanced financial spread, which is a spread between interest rates, and the enhanced real spread, which is the one between inflation and unemployment. And notice, when those things start getting close enough to dance with each other, we start really getting concerned about what the economy is going to do and predicting that the economy is going to slow down. I think it's very likely that sometime, probably in early 2020, or sometime in 2020, we're going to see this expansion end and move into a downturn of the business cycle that will probably be somewhat painful to the U.S. economy. Is it going to be painful like the Great Recession? That's unlikely. I don't think banks are doing the stupid things that they were doing before the Great Recession, and investment banks and people who are basically perpetrating fraud on investors. I don't think they're doing those kind of things, and I hope they're not. So I don't think this would be that kind of a recession, but still, we certainly see this economy slowing down. The other thing to watch is the spread on interest rates, and we hear a lot of people say, oh, the curve is inverting. Well, until last month, actually, I guess December, I don't think we could say that much. This is the spread between short-term interest rates, long-term interest rates on the top, and you can see that during the year of 2018, what we did was we compressed that curve. It got narrower and narrower. You can see the spread between the 10-year Fed rate and the Fed funds rate getting smaller. Look what happened in December, and we kind of threw a kink in this thing that's quite unusual. But what that tells us is that the predictors of an economic slowdown are probably playing out here, and we're probably going to see during 2019 a true inversion. And when you get an inversion, you'll get this rate lower than that rate, and you'll usually get a line that has a downward slope from left to right. So we're kind of heading that way. And back in April, when this thing first sounded the alarm, most people would look at that and go, well, there's nothing wrong here. Well, it looks like it's playing out just like it has so many times for Dr. Dealey's model. I think it's worth paying attention to. What does that mean for us? Well, in its extreme, like the Great Recession, it would mean a significant slowdown in meat demand. I mean, that happened in the Great Recession. We certainly saw meat demand slacken as especially consumers started eating less at food service establishments, and we saw the food service demand for our products go down dramatically. Retail demand went up. Grocery store sales actually rose during the Great Recession, and so that's an offset. But in general, we saw the lowest demand levels that we've seen in a long, long time during that recession. That's kind of unusual. For the pork industry anyway. In past recessions, we haven't seen that much impact on demand. And part of the reason was we're number 3 at food service. Okay? If you're going to have an impact on the food service sector, you're going to affect beef and chicken far more than you affect pork. Now, we have more exposure on the food service sector at this point than we've had in the past. How many of you have seen pulled pork sandwiches on menus that you used to never see? We have bacon on everything, okay? So we have some more risk here. I still don't think it's extreme unless we get the kind of recession we got in the last round. As far as quantity of product, we're going to have plenty of product to eat. Back here at about 2014, when we bottomed this out at under 200 pounds of the 4 major species, anybody that was here at the 2014 annual meeting heard me say, and we're never going back to 220 pounds. Well, never say never. Because it looks like we're going to get back to 220 pounds this year or next year on total per capita consumption in the United States. Why did I say that? I said that because there were lots of cultural things going on that I thought were going to change the nature of meat demand in the United States. Meatless Mondays, the rise of HSUS and others, and the problems we were having with animal rights issues. I really thought that those were going to have a bite, take a bite at the consumer level. But what we've seen is consumers really haven't paid much attention to that. If we bring them affordable meat protein, they will buy it. And that's exactly what we've done. We had to have prices high during this time period to overcome the cost increases we saw. Now we don't have to have that, and people are buying it again. If we put that with real prices, we have real per capita expenditures. This is the 3 species real per capita expenditures. You can see the impact of the recession here in 2007, 8, 9, and bottoming out in 2010. We had a big surge in 14 and 15, and we've been basically sideways since then. Year to date, the 3 major species down 1.5%. I don't include turkey here because we don't have a very good retail price of turkey. I don't know how that button keeps jumping up in the way. This is pork monthly, and you can see we had a tough couple of months in September and October on real per capita expenditures for pork. Very close to year-ago levels, and a better than normal seasonal change in November. Again, we're working with some old data. We should have December data by now, and we will have it early next month after the shutdown, after they get made up time for the shutdown. We're going to be down about 2% for the year as we go through and finish 2018. Beef down 1.6%. Chicken down 0.7%, so we've kind of gotten the worst of it this year after the last 2 or 3 years faring better than the other 2 species. But I'm still not terribly concerned about the level of demand. I think we have some natural variation in this over time. This is well within my comfort level. If this thing starts showing -3 and 4 and 5, I'd be a little more concerned about it. But I think we have a pretty strong domestic level demand. That brings us to exports. Now, we should be all crying in our beer over exports, all right? And we are to some degree. But we have to remember, we still have exports that have grown this year. They're going to be record large for 2018 on an annual basis. Up 4% from a year ago. Year to date, up 4.4%. November was a little tough, but it was compared to a very large November a year ago, kind of an unusually large one. Am I concerned? Well, of course you have to be concerned when you have these trade disputes with 2 of your normally 5 or 6 largest customers. And, of course, the trade disputes are serious with Mexico and with China. If we look at the performance of exports this year, you can see Mexico actually down slightly for the year through November. That's our #1 market, and it's been basically our only growth market for some time period. Japan down slightly this year. That's not too. We've been kind of steady to Japan the last several years. The concern there is that we're losing market share. Japan is importing more product. They're just not importing it from us. Canada and the EU have gained market share the last 2 or 3 years. They now have an advantage over us from a tariff standpoint because the EU had done a free trade agreement with Japan that was much like what we negotiated under TPP. Of course, Canada is part of the larger replacement for TPP, and that went into effect. One of them went into effect February 1. I think the other one goes into effect March 1. And so both of those groups are going to have an advantage over us going forward. Now, this is where the Trump administration, I know they've been a little busy with some things, but they said a long time ago, well, we're going to do bilateral agreements. We don't like those big multilateral agreements, and I understand that. Matter of fact, I kind of agree with it. I think bilaterals are better, but they're not better if you don't get them done. And so it's important that we get those done so we get back on the same footing. The real star this year, thank God for Korea, up almost 40% from a year ago. Canada down fractionally. Of course, China, Hong Kong down 25%. But growth to a number of other markets. Colombia is now a major market for U.S. product. The Dominican Republic continues to grow, even though it's still considerably smaller than others. The U.S. dollar is kind of back in this trading range. I mean, we've been in this range really for about 5 or 6 years here, since early 2015. We went out of it a bit a couple years ago when the dollar weakened. The dollar strengthened, of course, in early 2018, but we're back in here. I think we're in a place where, from a currency standpoint, we're very competitive with other providers of pork around the world. Which brings us to China. The situation in China, I think, is going to be dire at some point. Notice I said going to be. I don't think we're there yet. This is a country that eats a lot of pork. 88 pounds per person on the pork side, about 18 pounds of chicken, 10 pounds of beef per year. Their diet is pork. They have half the world's pigs in their country, and you can see the density of those. Of course, the most dense area is here in Sichuan province in kind of central China. But they're scattered everywhere, and there are lots of pigs. All of 2017 world pork trade, everything that we traded between countries in 2017 would only amount to about 15% of China's consumption. So if they lost 15% of their supply, they would have to buy all of the product that was traded in the world in 2017 to get back up to full. That'd mean that the Mexicans couldn't buy anything, the Japanese couldn't buy anything. Okay, so you get my gist. They eat a lot of pork. Very dense pig populations on millions of farms. They have 40 million farms. Okay, that's kind of hard to fathom. And many of them are small and in backyards. Thousands of small abattoirs that serve a wet or hot markets. I mean, they don't have a cold chain. They don't have coolers in many of their plants. They bring pigs in at night, slaughter them, they all go out, the plant is empty during the day because they've already shipped all the product out. Garbage feeding is common, and if there's a vector to spread African swine fever, it's this one. It's pretty easy to do. And in a country that feeds a lot of garbage, it was a disaster waiting to happen. To see the magnitude, I don't know what we're doing here, to see the magnitude of China. Okay, we'll try that. See the magnitude of China. Compare. You want to try another one? Okay. Okay. This is Chinese pork production, and this is the top 10 countries. Here's the EU, here's the United States. Everyone else, because of the effect that China has on this vertical axis, just compresses them so you can't tell anything about them. They're huge. I mean, they're so important, and this is so important to the Chinese diet. So what about African swine fever? Well, most of you are very well versed in what this disease is. It's probably the most feared disease in the world, mainly because there's no vaccine for it. It's not highly contagious, since it doesn't spread through aerosol, but it's categorized, and I was corrected by some veterinarians when I said highly contagious once, that no, it's transmissible. But it persists in feces, meat, and is easily tracked around. We had reports last week from a client of ours that has hogs in China about that had been spread into one of their farms and a lot of neighboring farms in feed that had come from a mill that had not followed any kind of protocol to prevent this spread. High mortality. Eventually, it'll get up to 90% plus. The farms we've heard of, you see a few hogs sick, and you kind of want to notice that, and you start checking them, and a couple of days later, those are dead, and another dozen or so are sick, and within a few weeks, all of them are gone. It was characterized by a veterinarian at the Banff Pork Seminar a few weeks ago that foot and mouth disease is like a wildfire, and African swine fever is like a lava flow. Okay? It doesn't go nearly as fast, but it completely scours whatever it hits. And so that's the kind of thing they're dealing with. It's carried by wild boars, which are susceptible. Warthogs, interesting, are not in Africa. But the wild boars in all of these places, China and the EU, of course that's a big problem in the EU, are a major vector here. There's no human health risk. But there is some evidence that we're already seeing pork demand in China suffer because of the presence of African swine fever, and we'll talk about that in a minute. Somewhere around 120 official outbreaks. That's nowhere near all of the outbreaks. We've heard stories of veterinarians going onto farms, seeing African swine fever hogs, classic African swine fever lesions. They say, nope, that's not ASF, that's PRRS, and they turn around and go home. It's a lot less work for them. The government doesn't have to pay indemnities. There's a lot of benefits there from the government side. But it's in 25 of the 34 provinces. There's one right here. That's Shandong. That the guy I talked to day before yesterday has hogs there, and there's ASF in Shandong. It's not officially declared an infected province. In the short run, what this has done is put pressure on Chinese hog prices. You can sell pigs that are sick. You can take them to market, and I mean it doesn't affect humans. We probably wouldn't allow that here, but it doesn't affect humans. And if you know your neighbor's got it, you're having very high. Here for you. Okay. All right. And if your neighbors have it, you know there's a high probability you're going to have it. So there's a strong incentive to get the hogs moved. So what's happened is the pork supply in the short run has gone up. We've seen the lowest prices in January since 2010. They have gone down in more or less a seasonal manner during the month of January. But there certainly we see plenty of pork available there in the short run. Regional hog prices have separated dramatically. You can see they were almost all the same back in August of last year. We've had a little bit of lessening of that. But this spread of prices is because you can't move hogs from places that have too many hogs to places that don't have enough. And it's created a huge incentive to move hogs across these regional boundaries. If you're in this one down here at the bottom, which I guess I can't tell which one that is, if you're here in the Northeast, you have a very strong incentive to move hogs to the Southwest, thus causing spread and causing more of a problem than what you had before. So what will happen? Well, obviously the control efforts have not been very effective, and they may actually have hurt. The early transport bans forced movement underground. Many reports of government officials that have overlooked ASF infections to prevent more work, indemnity, whatever. They're encouraging producers to build their own abattoirs, which is just wacky to me, and to restock as soon as possible. So many places still have the disease. If you're cleaned up, I'm not sure why you'd want to bring fresh stock into those kind of areas that quickly. And yet the government is encouraging that. Our contact, we have a guy that's been in Beijing for several years, a friend of ours. He's not an employee. But in a conversation with him right at the first of the year, he said, China has kind of an endemic 20% wean to finish death loss. That just happens. And that fits with everything we know about pork production in China. Even in the good operations, they have high death loss or very high vet med costs. He thinks that this could take that to about 30%. Now, that's just an estimate. But when I did the math on that, that adds up to 90 million pigs. All right, that 10% increase in death loss is 90 million pigs. We kill 124 million in the United States every year. Okay, to give you some perspective on that. All right, now, since then, I've seen about 4 other estimates that went at this in different ways, and all of them come up with about 100 million hogs as an annual loss from 2019. Now, we're still early in this process. It only started in August. And so when we start kind of seeing that kind of numbers, we're pretty sure that the timing is working against the Chinese pork industry. Farmers are selling now. Supplies are large. They're consuming or losing their seed as breeding animals die. So a lot of the animals that are dying now are breeding stock that would produce the pigs that they're going to slaughter in the summer and the fall. And we think that that's going to catch up with them sometime in the third or fourth quarter, and we're going to start seeing production significantly lower than in past times. But there are credible reports that that's having at least some negative and maybe as much negative impact on the demand side. We've heard from a number of contacts who know people in China who say that they're not buying pork. Or an operator that has several thousand seats of restaurant space in Beijing who is pulling pork off their menus, okay, because the people aren't buying it. Is that logical? Well, not really, but you have to remember what Chinese consumers have been sold in the past. they were sold plastic, and that was called protein. Okay, in the melamine crisis, and the government and these companies have taken advantage of them on many fronts. And if ASF were to come to the United States, our number one chore would be try to keep demand up, because don't you think HSUS and others would jump on that crisis and try to discredit pork in any way that they could possibly do it? All right, but this is a real situation in China. I don't know how much benefit there's going to be if demand lessens. Now, I will say this. Over time, I think Chinese consumers will see that nobody's dying from eating pork. Okay? And so I think they will come back to pork because they are a pork-loving consumer. But still, we have some real concerns about what's going on the demand side. What has been the impact? Well, this was August, and you can see that after this thing broke in August, futures for the summer made contract life highs well up here into the 80s. Now, we've backed off severely from that here recently. We think that some of the enthusiasm over ASF certainly has waned in the futures market. We don't think it's providing the kind of opportunities it was just a couple of months ago. But that's not to say that we won't see some benefits as we get into the second half of the year. And, of course, the deferred contracts really haven't moved much in the last couple of months. All right, let's talk about crops just a moment. I think this is a real positive for our industry. We have excellent crops. USDA reduced their estimated yield per acre in last week's report a bit, but we still have 1.73 billion bushels in projected ending stocks for this year, a stocks-to-use ratio of almost 12. If we, the next couple of years, we think there's going to be a big fight for acres, and the fight is going to be how many acres do we add to corn and take away from soybeans. If we add 2 million acres, we pull stocks down to about 1.4 billion in our estimate. If we add 5 million acres, we actually increase carry-out stocks of corn next year. So we think we're in pretty good shape kind of either way here, with corn priced in this 330 to 380 something on the average farm price for the coming year. Now, is that cheap? Well, no, of course it's not cheap, but it's certainly not expensive corn. The world situation is really what's driving what's going on in corn. Notice these numbers down here. This is world stocks, USDA's estimates at the end of February, 310 million metric tons. That's the lowest number since 2014 and 15. The stocks-to-use ratio, the lowest number since all the way back in 2013. So corn on a world basis kind of has a story here, and it probably is tight enough that we won't see a lot of downside potential on the corn side. To see that graphically, here's stocks-to-use. You can see the great tightening we've had just here in the last 2 years on the world stocks-to-use ratios. And so I think it's important to realize corn's probably where your risk is on the feed side. On the soybean side, USDA, this is the world soybean chart. I've got to move that other one back here. Again, here on this one, we're awash in soybeans. Look at these numbers for ending stocks. 64, 79, 98. We're all the way to 115 as of December's estimate. They dropped that down to 106. But still, we're at 30% stocks-to-use ratios on a world basis. We have plenty of soybeans based on this year's good crop in South America. I think we're going to have some pressure on soybean acres this year in the United States. If anything, soybeans right now are priced better than what we think the supply situation would anticipate. And you can see those stocks-to-use ratios very large. On the U.S. side, of course, 910 million bushel carry out. That's record large for this year, about 22% of total usage. Notice, regardless of what you do to the acres here, that number grows in the next year. And so, again, on the soy, two very different stories, but when you put them together, we've got costs here forecast on our model in the 63, 64 range. This would represent probably the best 20% of producers out there. The average producer was going to be probably $4 or $5 higher than that. But if you compare 67 to the board right now, most of the lean hogs futures contracts would be offering you a profit for 2019 based on these kind of cost levels. So a continuation of the costs that we've been in the last 2 or 3 years. When we put lean hog futures on top of that, right now the number for 2019 would be $8.60 or so per head of profit. That number was 14 and change about a month ago before we had this sell-off on lean hog futures. But still, again, profits for the better producers, probably break even for the average producer this year. The trouble is that's another year of break even. I used to use this chart all the time. I hadn't used it for a while. What I did is went back to 2004 and said if you sold 1 pig per month and put the profits in the bank, what would the balance of the bank account be? Okay, and you can see that if you were at the Iowa State estimates, as our model says, you'd be in very tall cotton. I mean, you'd have taken, from 0 to 2,000 over about $2,200 over this period, and that's a 15-year period. But if you allow $10 difference between the best 20% of producers and the average, here's where your accumulation would be. Not very good at all. There's no one that has stayed in the top 20% all the time, in my opinion. Everyone has had a health break on a farm or two or somewhere that has probably diluted that result. But the point is on average, we've got some producers here that really aren't much better off than they were back in 2007 or 8. And they've struggled for some time period, and any kind of negatives we have this year is going to put some financial crisis, some financial stress on some producers. We're hearing from banks that they have a few customers that are probably not in great shape, but there's some that still have a great balance sheet. So we think that another year in the break-even range, and we'll start seeing some farms change hands or a few even close by the end of 2019. Now, if we end up with a better year this year, if the Chinese get in our market big time the second half of the year, that could certainly turn the other way. All right, let's talk about our current situation. December hogs and pigs report, pretty much as expected. Very few differences between the actual percent of a year ago and the pre-report estimates. The only number that was over 1% different was the under 50-pound category, which said that we have we're lower than what was expected and had a very modest growth rate of less than 1% relative to the other market hog categories. The breeding herd was a little bit smaller than expected, but still pretty good growth at 2.4%. The point to make about the breeding herd, though, is that this number is 2.4% larger than a year ago, but it's almost exactly the same as the previous 2 quarters. So what has happened is we're seeing year-over-year growth, but that breeding herd has been very constant for 3 quarters in a row now. We expect it to be probably about the same number when we get the March report here in a few weeks. And we don't think there's much going on. If you look at sow slaughter, what we know of sow slaughter, which isn't a lot because of the shutdown, we've been slaughtering sows at a very normal kind of pace over the last couple of months. When we take 2.4% larger breeding herd, look at farrowing intentions, the March-May number looks a little low. The others are pretty reasonable. And then the other noteworthy number on here was 10.76 on the average litter size for September-November, only 0.2% larger than the year before. And that is kind of an odd number. If you look as we go through the years, a lot of seasonality here, but notice that this 4th quarter number in 2018, barely larger than the 3rd quarter. We think it's kind of an abnormality. And we think that the driver was the hot weather that we saw in May and June. If you recall, it got hot in a hurry last May. We had days over 100 degrees in Des Moines, and while we're not terribly susceptible to those kind of temperatures on breeding and efficiency, we still are. We haven't fooled Mother Nature completely on that. And so that would show up in September-November farrowings. And we think that that's probably the reason for this very kind of anemic growth rate here. Notice our forecast going for the next 2 years, we think we're going to be onward and upward on pigs per litter. If we look at the market herd, it's right on the trend, the post-PEDV trend. I don't think we've seen any change in that. And again, I would point out that we have seasonal variability within the year all through this chart. We have no cyclical variability in supplies in the United States now. The only changes away from trends are animal health events. First, circovirus vaccines in 2007, and second, PEDV in 2013 and 14. So we don't think that there's likely going to be any real deviation for this trend unless we have a major animal health event. So far this year, PRRS and PEDV have been much quieter than they were a year ago. We think that the short numbers we saw last September were probably the result of PRRS losses in late winter last year. We don't think we're going to have that this year. When we put this together and look at it on a weekly basis, here's our forecast for slaughter this year. We've got it up about We've got it up 3.3% for the year. Since December 1st, actual has been up 3.3%, significantly larger than what USDA's report would have said, a little bit smaller than where we would have said. The weather disruptions have certainly kind of wreaked havoc the last few weeks, and I think they're going to do it again this week on how many hogs we can actually get slaughtered. But still, we got packing capacity that by the end of the year we're going to be up 2.755 million per week. As I mentioned a while ago, the Prestige plant is due to open March 4th. We understand that they've actually slaughtered a few test hogs in there. Average weights are about normal. They're very close to last year's. You can see they're up slightly year to date, and we think that's consistent with the weather delays we've seen. But we expect weights this year to be up about 0.5% for the year, and so making pork production up about 4.4% year to date. We expect that to be up almost 4% for the year. So robust growth again this year for pork production, even though it seems like we're kind of, according to USDA, kind of slowing that process down. What does this mean for prices? Well, the cutout value's been under some real pressure the last couple of weeks, and we think it's a little unusual. We think we'll build a demand base there. We've got that cutout value moving basically sideways really through March, then trading up near $80, maybe 83 or 4 in August, and before coming back down into the mid-70s there in the fourth quarter. You can see we think next year we're going to be in some real pressure in the fourth quarter. If we look at national weighted average prices, we've been kind of bumping around here near in the high 50s. Now, the spot price has been down well below that, obviously, and that's a concern. But this would be the average price received by producers and paid by packers, including premiums, across all purchase methods. We've got that number only up into the low 70s for the summer. And that's kind of where I've been all along. Even when we had futures up at $85, I was saying, well, that looks like a selling opportunity to me. The fundamentals here say that we should have hogs up in the 70s. Now, that means on average for this year, we're going to be, like I say, about break even, just a little better on those models we showed you a while ago. Forecasts here for commercial slaughter. Iowa State has us up 2.6% for the year, LMIC 1.9%. This is pork production from USDA, so this includes slaughter plus weights. They're very bearish about supplies this year. They've got 5% on production. I don't know how they get there on that one. And then on the price side, Iowa State through the first 3 quarters, low 70s in the summer. LMIC doesn't even hardly get there, 63 to 66, just about the same as we were last year on average price for the year. USDA, again, quite bearish. These are live prices, so $40 here would be 54 carcass. Okay, $45 would be $60 carcass. Here's the futures as of, that says 1/11/19. That is not correct. That should be yesterday, or last Friday. So they would be $66 and change, hardly unchanged for the year this year. Notice, though, that most of the forecasts are low for the summer and low for the fourth quarter. So, again, we think there's some pricing opportunities there. What about beef and chicken? Well, the beef herd expansion has slowed but not stopped. There are lots more heifers in the slaughter mix now that has been pushing cattle slaughter higher. Cattle on feed numbers, record high. We've got a lot of cattle out there on feed. We think slaughter and production are going to be up 4 to 5% again this year. That's on 2 years past of 4% plus growth on beef output. The prices have been remarkably strong, and they've benefited from relatively strong demand. And remember, the beef demand number wasn't down as much as the pork demand here at home, but the big thing they've benefited from is export growth of 11%. Big growth in beef exports this year that have kept their prices strong. We think their biggest challenge will be slaughter capacity. This is a sector that has really cut back over the last decade when cattle numbers got so tight. There was news this week, of course, Sam Cain, packer in Corpus Christi, Texas, has been under some real financial problems for some time. It apparently sold in a bankruptcy auction. I don't know what's going to happen to it, though, because one of the reasons it's having trouble is a lot of the Mexican cattle that used to come across into South Texas to be fed and slaughtered at that plant are now staying in Mexico to be fed and slaughtered at new plants in northern Mexico. So I don't think there's a lot of future for that, but still, the beef industry finds itself in the same position that the pork industry was in about 5 years ago. We didn't have enough capacity, or maybe 10 years. We didn't have enough capacity. We had closed capacity and rationalized that sector pretty steadily over a long period of time. And now when our numbers started growing, we started taxing that, and taxing it severely in a few cases. Okay? The problem is it was at that time that I said on many occasions, the real challenge is the people that are in the packing business now have no incentive to go build another packing plant. Because if they go build another packing plant, all they do is screw up their margins for a couple of years, or 3 years, or maybe forever. So we didn't see Hormel or IBP or Tyson or Cargill or anybody going out to build new packing plants. Where did the new packing plants come from? They came from producers. Okay? Producers got together and did a marketing partnership with Seaboard and built Triumph. Producers got involved with Clemens Food Group and built Coldwater. Triumph got involved with Seaboard and built Sioux City. Okay? Prestige is building a plant in Iowa. It's all producers. It's not the established packers. Well, I don't think the beef industry probably can do that. I mean, they can't decide. The beef industry can't agree which direction the sun comes up. All right? Much less get together and put their money together in a packing plant. I think they are really in an intractable spot on this slaughter capacity, especially on the cow side. They're really tight on cow side capacity. Broilers, back to growth, but there's no consensus about this. And let me expand on that a bit. There are 6 new broiler complexes going to open this year or in early 2020. 6 brand spanking new state-of-the-art complexes. Added up, they would add about 2% or so to production. But yet, the economics of the broiler sector right now is not very good at all. They have extremely low breast meat prices. I mean, even wing prices are not very good. And if you add those all up, they're probably not in the black as an industry. But, it's kind of hard to get chicken guys to back off. And there's rumors that there are going to be cuts from the non-expanding entities, but can they be large enough to offset the growth from 6 new complexes coming on board? I don't think they can. I think we're going to see an increase in chicken production this year and maybe next, even though next year is kind of questionable. But still, when they do that, they're going to put some pressure on pork prices, I believe, because of lower chicken prices. Right now, one of the big problems is frozen chicken inventories. They've bumped their frozen stocks a year ago, and they haven't reduced them yet. We haven't got a cold storage report in 2 months, so we don't know exactly where they are, but that's hanging over this market big time. Okay, risks. A lot of negative side risks and not very many positive side risks. Now, the positive side risks could be really, really positive, but let's get to them. First, an export blocking disease. It's always number 1 on my list. It's more real right now because of the presence of ASF. This stuff can get passed around pretty easily. And the thing that I fear most is that in a tub of lysine or a tub of vitamins or something coming from China, everyone in this room I know will let that set for 2 months before they use it, which we've got some protocols that reduce the possibility, the probability of getting a live ASF virus in there. But if your neighbor doesn't do that, it doesn't matter what you did. Okay? That's my biggest fear. No progress on the trade battle with China. Who knows? We hear that they're kind of having low-level talks and they're going to step them up during the week, and everything will be happy by Saturday. Right. Significant delays for new packing capacity. March 4th is a delay. I mean, that's one of the reasons we got pressure on hog prices, I think, here in January and February. There were hogs that were going to be going to that Prestige plant before the end of the year that have had to find a home. And I think that has pressured hog prices. This is the same thing that happened with Sioux City's opening, supposedly in July of 17, that didn't happen until September. Labor challenges across the board. Availability, quality. I mean, all of you who have truck drivers know that that's a huge issue. It's having a big impact on the packing plants. And the packing plants are probably going to try to extract a larger margin to cover for some of the costs that they're having to incur on the other side of this with the electronic data logging and everything, which is on their product side. We've had some reprieves on the hog side, but it's certainly impacting the product side. Lower beef and broiler prices, we talked about those. And then, of course, any kind of economic slowdown in 2019 and beyond, that would be negative. It all depends on the severity of that. On the positive side, if China gets in our business, everybody's happy again. Okay? If they really need pork and their consumers do not back off on consuming pork, and they get in the market and we get this tariff situation solved, then the second half of this year could be very good. Our friend Brett Stewart has exports up only about 3% the first half. He's got them up 12% the second half because he thinks China will be in our market big time. Resolution to the trade battles, especially ratification of the USMCA. This thing has been signed by all three countries. We need their legislatures to get it ratified so that we can go back and we'll take the steel and aluminum tariffs off, and the Mexicans take the tariffs on pork. As we saw a while ago, we haven't had a big impact on the volume of products going to Mexico this year. I didn't show you the value chart. It's down about 10%. The Mexicans have very effectively extracted that tariff from the price of the product that they're buying. Ham prices, I think, will jump almost immediately by 18-20% when we get this thing ratified. And that'd add $4 or $5 to the price of hog right off the bat. Questions? Yeah?
We kill a carcass here about 213 or 214 in this country. Right now. What does China do? Do they kill a pig as big as we do, or is it smaller, or what?
Boy, I think, number one, an average probably doesn't mean much in China. All right? Some of those they haul on mopeds, so they can't be too big. All right? So they're all over the map. I don't even know what the average is, Brett. Somebody else in here know that? We have some people that have been there. I've never been to China, so I don't know. My guess is it's smaller because their grain costs are way higher. Okay, but I don't know the answer for sure.
I was just trying to figure out. We talk about head and how that.
Yeah. You said that there's a potential of the third and fourth quarter 12% increase in exports. Is that calculated in what you're projecting for prices for the third and fourth quarter?
It is. I'm using Brett's number in my quantity forecast and my quantity forecast feedback into the price model. Yeah. Well, the futures are still well above where our cash forecasts are for the fourth quarter. Yeah. So I think that's an opportunity. Yes, sir.
This truck driver situation is affecting a lot more than packing plants, a lot more than the pork industry. Truck driving is not rocket science, but I think it's actually easier to hire an astronaut now than it is a truck driver. So what's the solution?
I don't know. There are companies that have tried paying a lot more, and that doesn't seem to get it done. It's a tough job. I can't drive across to town hardly without going to sleep. So, I think it's a very difficult job. And I think a lot of people are finding that especially the long haul type stuff where you're away from home for so much is really a problem. You'd think that some long-term solution will be some kind of mechanical situation, robotics, auto driving. We have these things called railroads. Maybe we shouldn't have torn up all those tracks. I don't know. We put rails back in the Katy Trail. That'll do it, won't it? But, I don't know what the answer is right now. As an economist, my answer is always, well, just pay more. But I've read enough articles of companies that have really tried to do that, and they haven't attracted very many more drivers.
Can we import them?
Well, I guess we could if they could get through the fence. I don't know, but and I don't know what the situation is elsewhere, but I don't think truck driving is any better job in Europe than it is here. Okay, so I have not heard anybody talking about bringing in drivers from somewhere else. So I don't know what the answer to that is. My answer would be you try to pay them more. You try to change those working conditions that are causing people not to do it. Maybe you don't have the same driver in a truck all the way across the country. He goes so far, and you switch him off, and he drives the truck home, and he's at home tonight. Okay? Maybe we tag team those things so that those drivers don't have to be gone for a week at a time. That would make some sense to me. Yeah, it's kind of that kind of thing. You just put somebody else in the truck. Now, that's a logistical trick, but we have these things called computers that can work on those. Yeah, Scott.
The increase in Canadian exports to Japan has been pretty significant.
It has.
They've been chilled, and they're able to sell chilled
Oh
products.
yeah.
But isn't disappearance from Canada, isn't it kind of a North American market? Disappearance from Canada is just disappearance.
It is, yeah. If Canada sells something to somebody else, that's still pretty good for us. All right? It is a North American market to a great degree. If they don't get it sold to Japan, it'll find its way here. All right? So I would agree with that. I think longer term, what that means is that the Canadian industry really could grow some without putting any pressure on the North American market because of the growth in their exports to Japan. And they're doing that largely based on specifications and quality. I mean, the Canadian plants operate slower in general. They have everything invested in that Japan market, so they are very careful about specifications. Our packers are too, but I think they're able to do it a little better because of some control issues there. But I think what it does really is, but if they're going to grow their industry even a little bit to continue to gain market share in Japan, that's still market share that we could have gotten had we been able to match them on the quality side. Yeah.
So, as I understand, the total exports that we're doing are actually a little bit higher in volume, but lower in price, right? So it's a net reduction in exports. And you mentioned that South Korea is a significant destination to that. So if I could ask you to just dig into it a little bit more. Is it primarily a function of lower price that's leading to those extra exports? Is it market progress in South Korea, or is it just port traveling a little bit further to get to some places that it normally maybe can't go to?
No, well, I don't think there's any product to speak of going through South Korea that's finding its way to China. All right? You'd have to go, if you went by land, you'd have to go through North Korea. If you went by boat, you'd have to go across the China Sea to a China border. I don't think I'd want to try that. All right? The Chinese get a little ouchy about that kind of thing. And so I don't think that's it at all. I think what it really is the further development of that market as the Korea Free Trade Agreement continues to be implemented and tariffs keep coming down. Okay? Number one is our prices were lower this year. Number two is our prices to Korea were lower yet because the tariffs are continuing to go down. I think they're in like year 5 or 6 maybe. I don't know, Craig, if you know what year we're in on the Korea Free Trade Agreement. I'd say 5 of a 10-year phase down. Okay? So as you go through this, your product does get less expensive there because the tariffs go down. So I think it's just long-term market development in Korea that we're seeing the fruits of. That's the main thing. Jim?
This USMCA, is there? We look at it from the pork sector primarily, but is there enough incentive or are countries extracting enough benefit from the tariffs they're putting on products moving across all channels to not ratify it, or is there more incentive to get it ratified? Is that more beneficial for all?
I think, and I'm going to speak to you as an economist that probably is talking theoretical here. You're always better off with free trade. There are gains in letting people do what they do best, all right, and then trading. And we can just, so there's an incentive to get this thing done. There would be some perverse incentives of, well, we're collecting some tariffs, but we're also paying a bunch of tariffs. So, nobody's the clear winner in this tariff thing. It's tit for tat. So And if you take those out, you increase economic efficiency, and you're better off trading things than you are not trading things. So I think the incentive is to get it ratified. I think the problem is everybody's just preoccupied with a bunch of other stuff, and we need to get moving on this deal and get it done so we get these tariffs off and get back to where we were under the old NAFTA, which at the time was 0 tariffs between all 3 countries on pork and on a lot of other goods too. Yeah. Oh no, it's fine.
We're in a situation that's kind of gut-wrenching because if we sell pigs on the futures, it could be the very best thing we ever did.
That's that two-sided.
Yeah. If we sell pigs on the futures right now for October, December, it could be horribly bad too.
Well, it could be what it is and not as good as it turns out to be. Okay?
Okay.
All right? Yeah.
I've heard that.
Yeah. Well, but
When you write those margins,
yeah, I understand. Yeah. That's the reason God invented bankers.
I just see these two opposite ends. How do you operate this environment?
It is a real quandary, and believe me, we've spent a lot of time the last 4 months talking to our clients about, as John Lawrence said one time. Let's see, how do you not sink the ship and still not miss the boat? I think that okay. That's always the quandary with pricing hogs on the future with futures and options. A number of people have taken advantage of the African swine fever, foot and mouth disease insurance product that's out there. The first offering of that was a pretty good deal. The second one's an okay deal, okay, the one that's out there now. And that covers you if ASF comes to the United States or foot and mouth disease, and it covers you down to $35. It doesn't cover you below that, okay? So that helps some. On the other hand, you've got put options that you could do that puts a floor under your prices. But because of all of this uncertainty, the volatility in these things and the premiums on them have gotten huge. And so it's not a cheap thing to do. I mean, the insurance premiums have gone up here. And so then you start being creative about, you buy a put, you sell a call, you do these kinds of things that, we have several guys in our shop that actually understand all that. I'm not one of those, okay? But I kind of understand it. But if you sell a call, then if the thing goes well beyond that, you leave that on the table. Our thought so far has been get something that covers you so you don't lose a whole gob of money if we get it, okay? And then put something above it that even if you don't get the last $10 of the market, you still made so much money it doesn't matter. All right? Now, wouldn't matter to you because you made lots of money, Scott, but it would matter to me. But you have to kind of put some parameters around what you're willing to accept. But this bimodal risk thing that we have here is a very unique situation that makes it awfully difficult because it does increase the volatility and increase the size of those premiums. And so you can't just go buy puts. I mean, you just leave way too much money on the table, in my opinion. I mean, if you got to spend $5 for a $58 put, that's an awfully high risk premium, okay? So you got to be a little creative about it, and you have to adjust your expectations. I mean, if you get to sell hogs for $94, does it really matter that they went to $104? I mean, you still sell a $94 hog. Well, it does matter. I mean, it does matter. But again, what are you trading for? You're saying, I'll give up that to make sure that I don't lose the farm. Okay? So you have to adjust your expectations here.
Yeah. On the contract side of the business integrator, you track the financial viability of integrators. What's your outlook on M&A on that side of the the industry? Just overall, what's your opinion of the strength of our contract integrators?
Some of them are really, really good. There are probably a few that aren't. I would say that is a direct correlation to who has had the biggest health challenges. Okay? If you've got an integrator that you know has had several health challenges over the last 3 or 4 years, they're probably a little shaky. All right? Because that is, to me, the single most important thing of financial position that I know of. We don't track that. We have some of those as clients, and I'd have to shoot you if I told you anything about them. But we don't track it in general. I think, again, the ones that haven't had the health challenges are probably in pretty good shape. I haven't heard much about that, but you saw that line I had with the accumulated profits. There's some large people in that red line at the bottom. All right? I know of a couple of large ones that could probably be bought. So I don't see a pace that's faster than it has been, but I would say I would certainly not say, oh, that's not going to happen. Okay? Yeah, Walt.
In case you tell me that this question has no relevance and I'm worried about something that isn't important. However, and no negativism to our Smithfield friends, because we need them in this industry. But I can't help but think about the politics that's happening and the export issues with China and the ownership of Smithfield being in China. How or if does that embargo or just what do you think that, if any, unknown challenges that may have?
Well, I won't say the question isn't relevant. I think WH Group has had to behave like any other importer of pork to China. I do believe that if we got a resolution on the tariff situation and WH Group could bring that product in under a normal tariff regime, that they would be sitting in the damn catbird seat on this deal. Because all of that distrust about the domestic product, they'd be slapping their labels and Smithfield and all that on it and selling it as imported, wholesome pork. You don't have to worry about ASF and this stuff. Okay, I think they'd be in great shape. Now, that's a pretty big if. Okay, we don't have that done yet. I don't know that there's any other politics at play there other than that. I guess I haven't heard of any. But I base that on my judgment that getting ready access to wholesome U.S. product was the main driver of Shanghai and WH's acquisition of Smithfield in the first place. Okay? They come out of those times when people were fed melamine and called protein, okay? And they saw an opportunity there, and that's the reason they bought them, I think, in the first place. So what could be better than to be able to answer this crisis with product that you don't have to worry about? I would think they'd be really in a great shape. Now, what does that mean for us? It means we'd be in a great shape too, okay? Because they would have a really ready export market. Yeah, Craig.
South Korea was 2012.
2012. So we're 7 years in.
And some of the colors of the question of why Korea is doing well is health challenges in Korea.
Yeah.
Price point of U.S. high quality product.
Yep. Well, they're a higher cost producer all the time. Right. Thank you, Craig. Yeah.
Do you have some concern as you're speaking about it, a potential recession in as soon as 2020 that, we're starting out with such low interest rates right now and just had tax cuts. What's going to jumpstart the economy again?
That's a pretty good question. Well, that's the reason the Fed's been raising interest rates. Is anything that close to zero, they didn't have any bullets in the gun, okay? And that's the reason they have a pretty strong incentive to continue to raise them a little bit, is so that they have a stimulative trigger they can push. On the fiscal side, you're right. We did the tax cut. I don't know exactly how you do that again. There's a raging debate in the economics policy side now. Do a little search when you get home for modern monetary theory, MMT. There's some things that are right about it, but there are things that just scare the bejeebies. And the theory is here that a country that has control of its own currency, okay, the theory is that they don't need to worry about deficits. And they're right. I mean, we can take care of our deficit really easily. Just print more dollars. Okay? Now, if you're Greece, you can't do that because you don't have control of your currency. The EU is your currency, the euro. All right? So you've got a problem. You're kind of like Missouri. All right? Missouri couldn't take care of that. But that's the whole thing of this modern monetary. Now, and then their idea is that, of course, that causes inflation, that drives interest rates up, and you use taxation to pull those funds back out of the economy and thus slow the economy down. Okay? Which, it'll be tax under the name of tax the rich, but they'll tax all of us. Okay? So it's an interesting idea, but I'm concerned about that because I don't think there are many. Now, there's tax cuts and then there's also government spending. So on the fiscal side, you could go into a lot of stimulative government spending programs, but it's going to add to the deficit. And I'm one of those, the consequences on this side over here, but I do agree that I'm not terribly worried about deficits where we have control of the currency. And you say, well, we have all that debt. Well, then those people were pretty stupid loaning us money, weren't they? Okay? I mean, if I'm China, I'm not worried about China holding our debt. I'm worried if I'm Chinese holding our debt, okay? All right? So, anyway, I'm concerned about that. And that's the reason we've seen these aggressive rate hikes, okay, even on an economy that isn't just really smoking. We had to get some ammunition to fire at the next recession. So, that's another reason I think we'll see 2 rate hikes this year. But now 1.9, and I think they will look at the core inflation rate and say that's still a little iffy, okay? Because the only reason we had that sub 2% number was gasoline prices. Others? Well, I've kept you longer than you wanted to be kept. Thank you very much. Nice being with you.
Thanks, Dr. Z.